Investing in a troubled business presents a unique set of challenges and opportunities within the EB-5 Immigrant Investor Program. While the prospect of revitalizing a struggling enterprise can be appealing, strict adherence to USCIS regulations, particularly concerning job creation and capital maintenance, is paramount. Understanding the troubled business definition. USCIS defines a troubled business as one that has experienced significant financial distress. This typically means the net loss for the most recent fiscal year exceeds the greater of its net worth or 20% of the total assets of the NCE. The business has had 2 consecutive years of net losses. Advantages of investing in troubled businesses. The primary advantage lies in the regulatory flexibility offered by this classification. Job preservation versus job creation. Unlike standard EB-5 investments requiring the creation of 10 new full-time jobs, investments in troubled businesses only require the preservation of existing jobs. Minimum job requirement. The NCE must maintain the existing number of full-time equivalent employees for at least 2 years following the conditional permanent residence grant. Capital investment requirements and maintenance. The minimum investment threshold remains the same, but the deployment strategy differs significantly. The capital must be at risk and demonstrably used for the restructuring or reorganization of the troubled business to ensure continued operations. Failure to maintain the required employment levels, even if the initial investment was correctly deployed for restructuring, can lead to denial or termination of conditional residency. Due diligence in restructuring plans. Thorough due diligence is critical. Investors must scrutinize the proposed restructuring plan, focusing on feasibility of the turnaround strategy, the NCE's ability to meet operational benchmarks, legal liabilities associated with the prior business structure, compliance challenges and USCIS scrutiny. USCIS reviews these petitions closely to ensure the investment is genuinely rehabilitative and not merely a passive investment in an existing entity. Key compliance areas include the required documentation often involves detailed financial projections and operational audits. For example, demonstrating that the investor's capital directly contributed to the preservation efforts is essential. If the business fails despite the investment, the investor must prove they complied with all regulations up to the point of failure. Example of required evidence. Historical financial statements showing losses. Detailed business plan outlining job preservation strategy. Proof of capital infusion supporting restructuring costs. Conclusion. Investing in a troubled business via EB-5 offers a valuable pathway for job preservation, providing a regulatory exception to the strict job creation mandate. However, this pathway demands superior financial and legal expertise to navigate the complexities of corporate restructuring while satisfying the rigorous demands of USCIS regarding capital at risk and employment maintenance over the required 2-year period.